Hello, everybody. Welcome to the Mind Property Management webinar about how to grow your portfolio with value-added investments. We're super excited to have you today. This is one of a series of webinars we like to do to bring the expertise of the people that we get to spend time with in our network to all of you to learn about real estate, investing, and what can help you become more successful. With us, we have two really great guests. We're really excited, and I'll let them introduce themselves. But I just want to tell you that I'm super excited about having these two here. I know I've personally learned a lot from them individually in watching their journey over the last few years with Mind and growing their own portfolios. And so I'm super excited for them to share a little bit with you and to talk more about their properties. So, what I'd like to do first is maybe we'll start with Krystle. Just give us a quick introduction and tell us a little bit about your story.
Hi guys, I'm Krystle Moore and I'm based here in San Diego. I've been in commercial financing for about 16 years now. I'm kind of invested off and on, but we really got serious about investing in about 2012. So we bought our first apartment building initially with partners, and now we own most of our stuff just by ourselves. And our goal is really to continue to trade up in order to build our portfolio.
Awesome, thank you. Steve, give us a little bit about you.
Sure. So I run a company called Aventus Partners, and I've been in real estate since 2002. We started investing in self-storage facilities in 2002 and kind of built a portfolio through a series of acquisition, ground-up construction, repurposing of existing warehouses. And then we sold about 75% of that portfolio to a REIT in 2016, and I was living in New York at the time, and moved to California. And then since moving to California, I've been looking to sort of deploy capital into steady cash flow assets that produce stable cash flow on a long-term basis. And so we've been focused on multifamily, particularly in the Bay Area.
That is awesome. For those listening, I think one of the things that I take away from each of these is that we have two very different but respectively successful strategies to investing in real estate. Just to make it super, super simple, I think about Krystle's strategy as kind of near-term buy and trade up. And some of the things that I've seen Steve do over time has been really focused on how do we buy and hold for the long term. So these aren't necessarily mutually exclusive strategies, but I think throughout this conversation, we'll hear that there are very different but really interesting approaches to building your portfolio and being able to create long-lasting wealth for yourself. So let's dive in a second. I want to first make sure I get a good sense for who's in the room. So, if you could let us know in the comments or in the survey, how many of you actually own rental property? Give it a click. You'll see it pop up on your screen. But one of the things I like to think about in these conversations is who's in the room. And so if you share with us who's in the room, we can tailor our conversations accordingly and talk a little bit more specifically about what property strategies make sense for people who are thinking about investing versus people who are looking to optimize or grow their portfolio. So click away and we'll kick off here in a second. I see some of the submissions coming in, which are great. We'll give you 5 more seconds. Feels like a race. I'm seeing a bunch of people who have properties, a bunch of people planning to purchase soon, which is great. All right. Thank you for submitting. So, Krystle and Steven, just so you all know, we have about half of the room who own rental properties now, and about half of the room who are planning to buy rental properties in the next year to 2 years, which is really awesome. So I think some of the points that you all will present and we'll be discussing today will be really relevant for them.
Awesome.
So I want to kick off with the first property. So just for everybody's understanding, our conversation today is going to be pretty free flowing. We're going to go through 4 property case studies, 2 with Steven, 2 with Krystle, and talk a little bit about what they did, what worked and what didn't, and just have a conversation around these properties so that you all can get a sense for what the nitty-gritty looks like and how these strategies can be implemented in execution. So we'll start off with the first one, which is 3014 Fruitvale. So Steve, please tell us a little bit about this property and what you saw, and let's have a quick conversation about it.
Sure. Well, first of all, I like those pink shoes there. Those are cool. This was the second or third property that we bought. Really, the general strategy here is this is meant to be kind of a sleep at night type of investment for us. I have plenty of deals on the East Coast that don't let me sleep at night. But the basic objective here is to put money into buildings where you feel good that even if the economy falters, or if the rental market goes down a little bit, or the investment sales market changes, or the interest rate environment changes, that we're still going to have a safe, steady cash flow investment. And so we actually like rent-controlled markets because you find these dynamics where people are paying 20, 30, 40% below market. So essentially you're forming a floor in terms of how low your rents can go. That first day you buy the property is probably the worst day you're ever going to have in terms of just, what your rent roll is. I think even if the market comes down here, it might come down 5, 10, 15%. It's not going down 30%. So you've got a very good floor in terms of just the safety of your cash flow. And that's what this building had. So we had a rent roll where there was probably, I don't know, say 20 or 30% of the sort of aggregate rent roll was, below market. And we like the area. We like to buy properties in transitioning areas. So I don't buy 3.9 caps in the very best areas of town. We also don't buy 7 caps in the worst areas of town. We look for these areas that are sort of transitioning, and you can see that in the people that are walking around the street, the cars that are parked on the street, the retail in that area. So we try to buy in these areas where we can get some level of decent yield going in, where our downside is really protected, and where we've got a lot of upside. And the upside comes in turnover. And so our strategy really isn't to do anything amazing or super special in the first 1 or 2 years. We will do tenant buyouts when the opportunities come along. But at the end of the day, we just let time do its thing. We don't have a gun to our head in terms of when we sell these things. Frankly, the plan is to really never sell them. So if there's no turnover in the first 1 or 2 or 3 or 4 years, that's sort of okay. We're getting our yield. In this case, we've turned over about 40% of the units. So we just got lucky, and we projected that we're going to turn over 5 or 6% per year. We turned over 40% in the first year and a half, which has been fantastic for us. So our rent roll has gone up substantially, and frankly, this is a fixed cost business, generally speaking, right? Maybe your Oakland business tax will go up a little bit if your rents go up, and your management fee might go up a little bit, but your insurance stays the same. Your property taxes stay the same, your utilities stay the same. So when you have a 10% increase in your rent roll, that could translate into a 20% increase to your NOI. And if you got leverage, that could be an even higher increase to your cash flow. So in this particular property, the strategy was really to sort of make the outside look very inviting to new tenants, fix it up to the extent that we could, let the existing tenants stay in place and let time do its thing, and we've been very lucky with turnover. So this building's going great. And we actually own the one just to the left of it. You can sort of see in the background next to those stairs. We just bought that a few months ago as well.
Congratulations, that's exciting.
Thank you.
So I want to hit on a couple of things that you touched on, which I think is really exciting. I think first, when we think about these transitioning areas, right? Like I think you touched on some of the signals that you need to look for in order to kind of identify if the neighborhood's transitioning. Talk a little bit about why that transition is important to creating value with a property like this.
Well, I mean, frankly, we're looking for rising rents in the area. And, I think that there's some spots where people simply just won't move to because they might not feel safe. There might not be good retail around. It might be too far away from public transportation. We're really looking for areas where we don't have trouble renting units, right? When a unit becomes available, we can rent it, and that's important to us. So, it's kind of interesting in Oakland, specifically in other rent-controlled markets, because you'll see these very mixed populations, right? In areas where there's no rent control and all rents kind of come up together, you get sort of a more homogenous sort of like, group of residents that live in the area. Whereas in Oakland, you might have somebody who's paying $2,000 for a new unit and another guy who's in there at $800 and he's been there for 15 years. It's just a totally different tenant profile. So you see these very mixed sort of groups walking around the streets, and it's a unique sort of environment in these rent controlled markets. As far as just general folks walking around in front of the building, local neighborhood stores, etc. We also look to retail, because retail will really give you, I think, a sense of where a neighborhood is transitioning. When you see the check cashing places and the tattoo parlors being replaced by coffee shops and sushi restaurants, that's typically a good sign. So ultimately these units are going to be turning over, and so we want to have a strong ability to rent them. And yeah, I mean that's why, frankly, I also think the other reason is because people have heard this a lot. I've heard it a lot. I've never actually seen it. But I think the theory goes that if you're not in a good neighborhood, it might be fine now and the economy is really humming, but when a recession comes, those are the first neighborhoods to really get hit hard. And so that's why we look for these neighborhoods that are sort of doing well and going in the right direction.
That makes a ton of sense, and I really like the thing that you hit on in terms of being able to rent it. Just knowing your portfolio, I know a lot of the neighborhoods you're in could transition and be, if people are upwardly mobile in the economy, they can now afford rent and living in these neighborhoods. Or if the economy is really challenged, people who maybe might have been in the really nice buildings might need to check down to a neighborhood like this to be able to sustain their lifestyle. So you've just preserved a lot of option value in your property choices, which has been really great.
That's right.
Awesome. Well, thank you for that. I think we'll come back to you on another one, but I'd like to dig into maybe a slightly different property with Krystle. This is 4184 32nd Street. So Krystle, tell us the story of this property.
Yeah, and our philosophy as far as what neighborhoods we invest in are really similar to Steven's. So definitely I think he had a lot of really good points there, and that's kind of what the philosophy that we go by as well. But our strategy is a little bit different. 32nd Street is a 7-unit building that we purchased in a neighborhood called North Park here in San Diego. And North Park is a very transitional, up and coming neighborhood. There's a lot of more boutique style stores and bars and restaurants that are going in. It's kind of like the hipster neighborhood of San Diego. So we knew we wanted to be in an area that we could add some value in. So when we purchased this building, it was significantly under rented. It was an owner who'd owned the building for a long time, and they just were not that concerned about raising rents. So our plan going into it was to give 60-day notice to vacate all of the tenants and do a full rehab of the interior and exterior of the building. Some people like to go in phases with renovations. My personal theory and what we've seen just from doing property management over the years and doing our own deals is that the old tenants don't really mix with the new tenants. They're mad that they got the rent increases, and then the new people coming in are really excited for the brand new shiny place. So our philosophy has always been vacate the building, do the interior and exterior, get it all done, and then lease the units to people who are excited to move in and pay the rent for a brand new unit. So we did that. So we bought that building for $1,540,000, and we put about $265,000 into the renovation of the interior and exterior. And we increased rents about 40% as well across the board. And we refied it as well. So about 10 months later, we were able to refinance and basically get about 86% of our cash out of the deal. And at that point, it was pretty much just, sit back and collect cash flow. That's the other reason that we really like renovating buildings is it becomes really predictable as far as maintenance goes. So you don't have to deal with the nickel and diming every month when you go ahead and replace pretty much everything. You just have a very predictable building. You can count on that cash flow every month, barring a vacancy or something like that coming up. So that's what we did. We cash flowed it. I owned that property for about 2.5 years, and we actually just sold it in April of this year for $2,475,000. And we calculated that at 167% return on our investment. And our philosophy there was basically we had basically maximized the income on the building. So I really couldn't get very much more in rents. My cash flow is pretty set. So if my goal is to grow as an investor and I'm not raising money, the easiest thing for me to do is to sell this property and use that cash to trade into a larger property, which is exactly what we did.
That is awesome. That is super awesome, actually. And I took a bunch of notes while you were talking. So one thing I'd like to first understand is, how did you finance this initially? And the reason I ask that is, when I think about you getting 86% of the capital back in the refinance, I mean, number one, that's great. That means that you can reallocate that money into a new investment. So that's awesome. But I'm curious how you were able to create a capital structure as an individual investor, as somebody who's not like attached to some big fund. How did you create the capital structure so you had that flexibility?
So on this particular deal, we actually did get bank financing. We had a relationship with a lender. This was about our third deal as well that we had done ourselves. So we already had that kind of relationship, and we were able to get a decent loan to value. I got $1 million loan on the initial, and we were in a 1031 exchange. So we were able to use our 1031 exchange funds. And then also we were able to borrow some money from, a client that we knew that lends their money out for the rehab. So that's essentially what we did for the financing. But that being said, if you are looking to do deals like this, lenders are probably going to want some sort of experience, but there are like bridge loans out there that are available that will fund up to even 75% of your purchase plus rehab costs. So those kinds of loans are out there. They're of course a little bit more expensive, but we consider that the cost of doing business, and we've certainly gotten private loans in the past. It's painful to pay those points, but they do allow you to do what you need to do on your property and get optimal financing once you're done with the project.
Spoken like a true lending expert. One of the things I take away from that point too is there's a lot of value in getting started. So we talked a little bit earlier about half of the people in the room today are people who are anticipating buying their first investment property in the next year or so. And I want to really underscore this point. Like, you just said this was your third deal, and you also said sometimes financiers need a track record. So I think it's really important for people to get started, right? Like you can find a good deal. Like, don't make bad deal decisions, but it may be a single family home that you then do some work on and flip into a duplex, but like it doesn't have to be the 10-unit place or the 5-unit place or the 50-unit place today, but you just got to get started so you can get experience and also develop that track record that people can bet on.
I started with a single family house. So, and I did what a lot of people probably aren't willing to do is we lived in it for 2 years, of course, renovated. That's apparently what we love to do because everything I buy, I fix up. So we did that with our house. We lived in it for 2 years. We took advantage of that tax law that allows you to make up to $500,000 as a married couple tax-free. And so I am a renter today. I own plenty of apartments, but I still rent. And the reason for that is that I want all my capital working for me. And my philosophy is one day my apartment building is going to pay my mortgage. I'm definitely not going to be paying it out of the money that I make in my job or my career or my business. So it's not a very popular idea, but people ask us all the time, how'd you get started? And it's really, there's no magic. There's a lot of sacrifice.
I hear that. Well, keep on sacrificing. We'll come back to you in a second. But I want to dive into Steve's second property, which is the one on Georgia Street in Vallejo. So for those of you that don't know, Vallejo is a town in the Bay Area. And it's actually, I would argue, as a whole town and area, one that could be up and coming. And so, Steve, tell us a little bit about the story on this building.
Yeah, this is a 26-unit building. It's in the historic area of Vallejo. And this is not a rent-controlled market. But what we've tried to identify are these cities where people are moving to basically escape the insane rents in other parts of the Bay Area. Oakland rents and San Francisco rents have flattened out a little bit. I don't think that's really for lack of demand. It's just people can't afford to pay it anymore. I mean, when you're unit is $2,000, you know, the rule of thumb is that you're going to make 3 times rent. So to afford your $2,000 unit, you got to be making $75,000 a year. And there's literally millions of people that make $50 or $60 or $70,000 a year. I mean, these are just folks out there getting up and going to work and doing their thing, and they make $60,000 a year, and they're getting priced out of some of these places. And so what we're seeing is if you can identify these areas quickly, you can kind of catch this updraft in rents. And in Vallejo, 5 years ago, you could rent a 1-bedroom for $800, and we're renting 1-bedrooms for $1,600 now. And the landlord was sort of a little asleep. I mean, I don't think he quite knew how quickly rents had gone up. And you know, we bought this building based on folks paying, you know, kind of a blended average of $1,100, and now it's looking more like $1,600. So the nice thing is there's no rent control. So I mean, we can increase rents as fast as we want. So we've tried to take a little bit more of a judicious approach in terms of our rent increases, because I don't want to end up in the paper, and we don't want to see little old ladies get kicked out into the streets. So, you know, we just raised someone's rent from $8 to $925 when market is $1,600, because we're trying to be humans about this. But at the end of the day, this will be a great project just because we caught this sort of updraft in rents, and I don't think it's going back anytime soon.
Awesome. And tell me a little bit, so with the first building, I know you did some improvements to the exterior. Did you do anything from a, you know, renovations perspective to these buildings, or the units?
This isn't the best picture. It's sort of a long building, which would show the scale a little better if it was taken from the other side. But this was built over 100 years ago, and the sort of frame and the wood and the foundation were like amazing. I mean, they were in incredible shape, and we didn't need to do anything. But, you know, I had old knotted tube wiring, and, you know, everyone had like literally like 1 or 2 electrical outlets in their apartment, and you'd like blow the entire building system if you plugged in your hairdryer. And there's leaks all over the place. So we're investing about $400,000 in an entirely new electrical system, an entirely new plumbing system. And so really the guts of the building are being completely replaced. And really it's just a maintenance issue. I mean, I don't know if the tenants appreciate new plumbing that much, but I do, when we're not having to go and fix leaky pipes all the time. And at the end of the day, what we're finding here at this particular market is we're not even having to put a lot of money into the units when we turn them over. So it's a coat of paint, and you know, we'll see how things go. I don't think you're going to get paid in markets like this. You could put $25,000 into a unit, you might only get an extra $100 or $200 a month. It's not really worth it at this stage. So this behaves a little bit differently than like an Oakland market, where you really do get paid for a very nice renovation. So it's a little bit of a different operating strategy, but we're very happy with this building. I mean, this will be a great deal for us.
That's awesome. And actually, I think that last point you made is actually really key. So I know the conversation here today is about value add investment, and a lot of people will interpret that as you got to find a building that you can make renovations on and improve tomorrow, and including the internal components of it. And some of what you just hit on was there are guts components, like the bones of the building, that you needed to work on to make sure that you weren't spending a lot of money over time, which is very smart. But the last point about like investing, you know, $25K in a room or a unit to be able to get an extra $100 or $200 in rent, like that is just ROI that you're looking at that point. Like, how long will it take me to pay this investment off? That's like potentially like 10 to 20 years of payback time. That's not worth it at that point. So that's really key.
Yeah, that's true, but I kind of look at it on a cap rate basis, and it's strange because you can almost justify the most insane renovations if you look at it that way, right? Because you can add extra, you know, an extra $100 a month is what, $1,200 a year, which is, I don't know, it's a $20,000, you know, $30,000 increase in value. So it's easy to justify some pretty crazy renovations when you're looking at the calculation on a cap rate basis. But I agree. I mean, it's also kind of a matter of like, how long is it going to take to return that money, and what market are you in? It doesn't make sense in this market.
And even by that thought process, right? Like, depending on where you think you land on those rents, it may break even from a cap rate and an equity return perspective, or it might not. So it's like important that you at least are clear on what kind of ROI you're looking for, right?
That's right.
Yeah, that makes sense. The other thing I'd like you to talk a little bit about, because I think this is important for people who are looking in California as well as other markets, is how did the transportation infrastructure in Vallejo and the evolution around that play a role in your decision that Vallejo is a place that you should even look?
Yeah, I mean, I think we always want to make sure that people can commute into the city fairly easily. You know, you can walk to the ferry from this building and be in the city in an hour. So it does matter. We have recently kind of come up with a ranking system for buildings that we're looking at, and transportation factors in, parking factors in, how difficult it is to find street parking if there is an on-site parking factors in. And so that is kind of part of the overall equation when we're trying to figure out whether a property is any good or not, is the sort of general walkability and general access to transportation that a building has.
I mean, and that's huge because as more and more of the cities in America become traffic heavy and traffic dense, having access to alternative routes to get to work are so critical. So like you said, I know in this particular area, the freeway traffic can be a mess and you'd have to go over potentially 2 bridges to get to San Francisco if that's where you're going, versus like just hopping on a ferry and, you know, at least having the alternative during rush hour to take a different route to get to work is going to be hugely valuable for you. So that's great. Awesome, thanks for that. Let's talk about our last property, 4183 Alabama. So this is another great San Diego property. So Krystle, take it away.
Yeah, so this property was kind of similar strategy as 32nd Street. It's in a similar neighborhood as well. It's basically right next to North Park. A little bit, I would say, of a nicer area there, but there's just a ton of small multifamily there and a lot of opportunity to add value. So we bought this building in 2017 and we bought it at 9 units, and we did a little bit different here. Our strategy was still to renovate and increase rents, of course, but we left a couple of units that weren't really in that bad of condition. And basically, you know, our theory was that the new buyer would have a little bit of meat on the bone to add value themselves if they wanted to. And the other, you know, 7 units were kind of a good idea of what they could get. So, and the rents were a little bit higher. They weren't so under marketed. And to Stephen's point, sometimes you look at something and say, if I'm only raising rents a couple $100, it really doesn't make sense for me to spend $20,000 or $25,000 in a unit. So that's basically what it costs to redo everything in a 2-bedroom apartment or even a 1-bedroom. So anyways, we did buy that property. We put about $175,000 into this renovation. So, and refinanced it again. So like 5 months later, we pulled out a little bit of cash. This property we purchased with private money. So we could not qualify for a very high loan amount, and we did not have the capital to, like we did on 32nd. So we went and got a private money loan. So an idea of what that looks like is we paid 8% and 3 points to close on it. And then 5 months later, we were able to refinance it out with, you know, regular financing, very competitive financing, and recoup about $70,000 of cash that we put in, and just let it cash flow. So we were able to finish that renovation more quickly, and we didn't quite get as much cash out as the first deal. But we also just sold that deal in April of this year for $2,875,000, and that was 140% return on our investment. So we actually took the 9 unit and the 7 unit and traded into a 30 unit property here in San Diego, which actually a little more than doubled our monthly cash flow. And that's just like a primary example of why we buy, renovate, and eventually sell. That property we sold in about 2 years. So I wouldn't say that we're true flippers, but we are more on a short-term hold. I usually say that we're gonna hold properties anywhere between 2 and 5 years, because I need to make sure that the metrics work. Again, if we go into some sort of a recession or we see a dip in the market, we want to make sure that we can still operate the property and cash flow positive. So our kind of strategy is 2 to 5 year holds, and we kind of just see how things are going after a couple of years and see if it makes sense to sell and trade up.
That is super helpful. And first, again, congratulations on that. That's awesome.
Thanks.
Tell us a little bit about how you found this opportunity.
So we kind of had a relationship with the previous property manager. I didn't talk with them directly on the deal. We've got several relationships with different apartment brokers, and they bring us deals. And part of the reason they do bring us deals is because we like to be easy buyers. We definitely do our due diligence and we do our inspections, but when you're a pain in the butt, especially if you're a newer investor, people are going to call their best clients first, and their best clients are going to be who makes their life the easiest. So our broker brought us the deal, and it just so happened that I knew the property manager. They were the manager for the first property I ever took over on my property management company, and we just had a good rapport with each other. So I got our offer accepted out of 15 other offers. So it was not easy to get the deal, and there was definitely a lot of competition here. But I think the relationship that you have, and then just trying to do your due diligence, but not be too difficult when you're purchasing.
I think that's a really good point too, because when you have a relationship, you can also get information that you can't always get just from the offering memorandum or the listing sheet, right? Like you probably got some background on the owner and what investments they made and things like that, right? I would imagine, right?
Absolutely. And to that point, going back to the 32nd Street deal, we got that deal instead of a broker's top client. They ended up having some issues. The client was being difficult. And so we ended up getting to purchase 32nd over someone they had sold multiple deals to, because we were like, we're ready to go. We know exactly what we're here to offer. We're not going to play games. We're ready. So again, no matter even if you bought 4, 5, 10 deals, sometimes if you're that difficult, there's always a bigger fish out there than you, right? So I look at it that way and go, I have to be an easy person to work with. This is a team, not a battle. So, and like you said, the brokers can give a lot of background information, as can the sellers or the property management company for the seller. This was owned by a Catholic church, so they were doing bare minimums, and the property managers were a huge wealth of knowledge for us on deferred maintenance and items that we would need to take care of immediately.
That's awesome. Now, you've said this a couple of times and I want to hit on it, that you had your own property management business. And I know that just having known you, but I could see that as being something people would hear and then say, oh, you know what, I should buy and manage my own properties. Like that sounds like great cost savings. And to your point, that sounds like you continue to get intimate knowledge of your business, your building, and potentially other buildings. But tell us a little bit about how the property management work that you were doing, even for your own buildings, impacted your ability to go out and find new deals or continue to build your portfolio.
Certainly it helped give me confidence in our market, because we were managing buildings all over San Diego. So I knew market rents in certain areas. I was able to see other buildings that were trading. I was able to hear feedback with leasing and things like what kind of finishes people were looking for or liked, and what kinds of things they didn't like. So it was definitely a learning curve, but I will say, I never treated my properties any differently than the people we were managing for. So I was not really involved in the day-to-day, and I encourage people not to self-manage. For one, there's a lot of kind of fair housing issues that you need to be apprised of. You definitely need to know when you get into a difficult tenant situation, which will happen if you're a landlord. You want to have a professional company that knows how to handle that knows the laws. And if you're an owner and the tenant knows it, you're already at a disadvantage. So that can become a real challenge. And then you're getting emotionally involved, and this is a business. So I have to look at this like a business. Of course, I try to be as compassionate as we can, but at the end of the day, businesses need to make money and they need to be profitable. And we're not doing anything over and above what the market is calling for, what the market is accepting. So having a professional to kind of be that intermediary is very good. And the next most important thing is, if you're involved in the day-to-day, that person who has a leaky faucet, or that person who needs their screens replaced, or that tenant who doesn't want to pay rent and has 12 excuses as to why they can't pay, this is all sucking up valuable time that you could spend looking for deals and building relationships with brokers and sellers to get more deals or making more money to do more deals. So for me, I look at it and I say my time is so much more valuable than getting involved in these minor details. So I'm more focused on the big picture than I am looking at the minor details of my vacancy or my maintenance that should have been a few dollars cheaper, or if I could have saved $50 on that bill, or, you know, those are the kinds of things that I don't look at as much. Of course, if there's big problems and your building's not cash flowing, you need to dive in and see what's happening, but I'm not doing that on a day-to-day basis, and it's not the best return on my time.
I think that's right. And one thing I like to advise people to consider is, are you making this investment in this property to give yourself a job so you can be a property manager,
Right.
or are you doing it to create wealth? Those are two different activities. I think that's right. Well, thanks for that. So I think, you know, I've taken a bunch of notes during this conversation, to be candid. You know, some of the things I wrote down were just neighborhood selection. I think that came up frequently in each of your discussions around the investments you made and why they made sense to you. And in particular, just getting to know the area, right? You know, real estate is about the local market. And if you can understand transportation infrastructure changes, social changes, retail changes, and where a neighborhood's going, that will really help you make better decisions. Another thing that I thought you both hit on that was really important is just like having a clear sense of what your goal is for the investment and your general strategy. So on the one hand, Krystle presented some strategies that were focused on increasing equity quickly and creating liquidity with that equity. So let me invest in this property, do some things quickly that allow me to make more money, and then take that money to go invest it into bigger projects. Steve looks for opportunities that allow him to create that value, but also he can hold for a really long time. And so he can be patient with what he's doing, make decisions and investments that over the long term pay off for that portfolio and make it more and more stable. So I think it's just going in, knowing what you're trying to accomplish is even really important. The last thing I think, at least I wrote down in particular, Krystle hit on this a couple of times, is just knowing your financing and just understanding how your cost of capital plays a role in. If you are clear on how you're going to finance it and you can get creative with the financing, I think that's going to be really valuable because, you know, candidly, that impacts your ability to make those great returns on your own money. And we all like to use other people's money to make money. So just knowing how you're going to finance a deal is really key. And the last thing that you hit on, actually, I think both of you actually hit on this, was relationships and building a team. So at the end of the day, everybody on this call, you two are investors, people who are looking to do something that creates wealth that they can put into assets that can then sustain their retirement, create value for going to have fun, paying for activities down the road, whatever your plan is. But you can't do it by yourself. You need lenders, you need repair people, you need brokers to help you find deals, you need people who know the local markets. And so I think just continuing to remember that this is as much a people business as it is a property business, and knowing that you need to invest in those relationships to help you make better decisions is going to be really key. So I want to thank you all for those takeaways. We're going to start having some questions here. I've got some that have already come in, but for people who want to submit questions, there is a section in your interface to submit questions. So I'm going to lob over some questions to Krystle and Steven, and you guys can answer them as it makes sense. First thing is, so I guess let's start with Steven. Especially given you're holding these for long-term purposes, like what kind of creative strategies have you been implementing to manage your taxes and the tax implications of these properties?
I don't know if they're all that creative, but one of the things that we really focus on is our post-tax return. Probably 90% of the projections I look at in any business are pre-tax returns. But at the end of the day, depreciation on a building is really important. And so, look, if you're buying a building and it's a 5 yield and maybe you're putting a little bit of leverage on it, so maybe you can get that up to a 6 or a 7 or something like that. Mostly, just given the economics, you're not paying any tax on that just because of the depreciation shield that you get from, the tax laws that are out there. And so if you were to compare that to, say, a bond in which 100% of your interest is taxable, you need to find a bond, particularly if you're in a higher tax area and you're in a higher tax income bracket, that's yielding well over 10% to get the same after-tax return. And so, that's really important for me. It's really important for some of our investors is sort of understand that post-tax return because it matters. And, we haven't paid a dime of property tax on any of the cash flow from our properties just because it's been shielded from depreciation thus far, and it will be for a while.
I like to think of real estate as the ultimate cheat code for taxes to a certain extent. And I'll tell you, one of the things I've learned from you in particular is in looking at some of the underwriting you've done, I don't know why I didn't register to me before to look at, after tax adjusted returns for, investment A versus the real estate deal. But I think that is actually a really important thing people should keep in mind, right? Taxes impact how much money you keep, which is at the end of the day, a big reason why you make any investment. So you got to look at those things apples to apples.
That's what matters.
So to that point, Krystle, I mean, you're doing things where you're recycling capital, you're taking money out to put in other investments. Like, how do you approach tax management?
So we're actually kind of looking more into that this year for a tax return. And in the past, Stephen's right, we end up really paying no tax because depreciation is there on the income on the properties. And we're also getting a lot of operating losses that we can carry forward. So we have pretty decent sizable losses there because we're doing so much renovation work on our properties. But that being said, if you have a business or you have a W-2 income where you're making excellent income, for me, I have 1099 income that I would need to pay tax on, and my husband has the W-2 income. So what we're doing now is we have hired a new CPA. It's the CPA that, does all of Robert Kiyosaki's tax returns. So what they're trying to help us do is to be in those two right quadrants, right? To operate our business like a large business, and then to be that real estate investor where we're hopefully paying no tax. So we're looking now at potentially not even utilizing 1031 exchanges for our purchases based on our advice from a CPA, and I'm certainly not a CPA, so you should talk to yours after this if you're looking at this strategy. But if you can become an active real estate investor, you have that bonus depreciation that came into effect with Trump's 2017 new tax laws. So we're looking at having potentially a better advantage of using bonus depreciation versus using the 1031 exchange. So I can effectively write off 25 to 35% of my new purchase, and I purchased it for $5.7 million. So I could have about $1.5 million of, income that I can write off technically for a write-off versus I think it was $660,000 on my 1031 exchange. So it makes more sense to potentially do the bonus depreciation. It's something that you've got to look at. You've got to get a cost segregation analysis on your property to make sure it makes sense. So on these two sales, we didn't really think about it before we closed. We actually did do the 1031 exchange with our accommodator just to make sure, but we don't have to utilize that on our tax return. So that's something that we're really looking for. And the bonus there is that you can use up to $500,000 of your W-2 income and essentially get back all the payroll tax that you paid in, or use up to $500,000 on any other sort of business income. So it can be a huge advantage if you utilize it. But again, definitely talk to your CPA about it, and you have to be an active real estate investor, which means you have to have 750 hours a year of working on your properties or doing property related activity.
Perfect. Some things I want to make sure people caught: cost segregation analysis. Make sure you all Google that. I know for a fact that is a surprising thing that people don't know a lot about, and it just is found money. So please look up cost segregation analysis. And then 1031 exchanges. So it's come up a couple of times in this conversation. Again, please Google that. It is. Real estate is the ultimate cheat code for taxes. So I'll just leave it at that. So Krystle, there's another question that came up. I think it's good to at least start with you on. When people have heard the amount of money that you've been able to extract from some of these deals, to a lot of people, they're like, well, that's great, but like, why take the risk again with real estate? Like, how often can you keep this up with the cycle going up or cycles going down? So why not take some of that and invest it in the stock market, for example? How do you think about that?
I'm not comfortable with the stock market personally. I don't know a lot about it. We do have a little bit of cash, like very small, maybe 1% of our cash in the stock market we play around with. But for me, real estate is just about the safest thing that you can invest in. It's tangible. You can drive by it. You can look at it. It's not going to disappear overnight unless there's just like an absolute disaster that happens, in which case a lot of people would be affected. But and multifamily for me specifically has been the kind of real estate that I like to invest in. People always need a place to live. So I think it's really safe. And one thing I did want to mention is all of these deals that we purchased, we could have bought for a long-term hold as well. We didn't have to do this. They would have been good cash flowing deals if we had not done the renovations. My main goal is always to grow in the number of units. I want this to be, there for us when we retire. This is my retirement. It's, here for my kids to pass on to them one day. I'm thinking more about legacy and, making my life easier later on down the road. So that's why I have that strategy. All of these deals were purchased under the premise that I could operate it as is, maybe doing rent increases based on the market without investing all that cash. So that is an important point that people should definitely note. I would not buy a deal that was negative or that I wasn't able to at least cover my costs, and hopefully you're making money, because that's the point of investing. So
That's awesome. Steve, just a kind of related question. So one thing that came up is like when you're building your own team, like who would you want to have on your starting five? Like what kind of people do you want to make sure you have on your team, especially given you have the complex markets that you're operating in?
Yeah, it's a good question. I mean, I think the most valuable resource to us would be somebody who can find deals. I mean, that's the shortage for us. There's just not enough of them out there. It's a competitive market. We want to be in markets that we actually understand. I don't like going to markets that I'm just driving around for the first time and seeing a building that I'm thinking about buying, but I know nothing about where I am, and I couldn't take someone on a tour there because I'm clueless. So, a valuable person would be somebody who can find deals, be an expert in a market, because that's a scarce asset for us. The scarce asset for us has not been capital so far, hasn't been, we're not getting bogged down in management because we let Mynd do that. So, our strategy really is to buy deals, get them stabilized. It takes generally about a year or so to do that, and let Mynd run them for the long term. So we look for projects that aren't going to soak up a ton of our resources in terms of time for very much longer than a year. We want to be able to put them in sort of autopilot, so to speak. And so that's essentially outsourced through Mynd. And so really now it's just finding more deal flow. That's what's important to us.
That's helpful.
So actually, if you can help us do that would be great.
I just got another question after you just made that point. And the question is, this is maybe good for both of you. You can answer, and then we'll have to close. So if I'm going to, it sounds like you both work with a property manager. What kind of questions should I be asking Mynd to make sure that they are the right property manager for me to work with, or any other property manager? So, maybe Steve, will start with you. Like, what kind of questions would you ask a property manager to make sure they're the right people for your team?
Yeah, I mean, one of the things that's important to me, just to start off, is reporting is really important to me, right? When I get the P&L, I like detail, and I don't want to have to pick up the phone and, have to ask a whole bunch of questions to find out what one particular expense is for. I like all the sort of detail behind it. And so I like that sort of, a property manager would send me sort of the high level P&L, and then behind that comes all the nitty gritty. So it could be 2 pages long, or it could be 30 pages long. Mine are 30 pages long. And sometimes I only need to look at the first 2 pages because things are great. And other times I want to dig in more deeply. And for me, having all that information already there is good, and making sure that you're confident that it's accurate is good. We do have investors, and we're super transparent. So that's one of the sort of key philosophies of Mynd and just operating any business is total transparency. So we put all this information up on a shared drive for our investors to see. And, frankly, I don't want to have to worry about whether it's accurate or not, right? I just want to be able to drag and drop it, click, put it in the shared drive and feel good that it's right. So that's important. The second thing is just keeping maintenance costs low. I mean, at the end of the day, a lot of your expenses are predictable, right? Your taxes in California are 100% predictable. Your insurance, you can get a quote before you buy a building, 100% predictable. Most expenses are very predictable, except for repairs and maintenance. And that's the one thing that can kind of bite you. And in the Bay Area, where somebody swinging the hammer can earn 150 bucks an hour, you really need to manage that stuff closely. So important to me is somebody who can sort of manage the leaky faucet. That's not going to cost you $250 to fix. I mean, it's nuts here in California right now. There's a shortage of labor, and you can just get raked over the coals on just normal repairs and maintenance stuff. And then lastly, it's just making good decisions generally. I mean, multifamily, we have a fairly significant portfolio of self-storage assets that we run, and it's stuff, right? No one's stuff is calling you at 2 o'clock in the morning because the toilet's clogged. It's a totally different kettle of fish than multifamily, where people actually live in those buildings. And you got to be able to make good judgments, right? I mean, these are people who, in some cases, will fly off the handle if things aren't handled properly. And so it's about just, it's the multitude of number of little decisions that build up over time that create success on a property. You got to know that your property manager is good at that stuff. They got to be able to deal with people well. And so that's sort of the third thing that I would pay attention to when selecting a property manager.
Hear that. Krystle, as a former property manager yourself, what would be the one question you'd ask to make sure that they're good?
Yeah, I agree. I think maintenance is a big one. For me, it's all about, as a former property manager, it's pretty much, I know that as long as people are getting their money, they're happy. They don't really care about all the minor details. But when you do have those big unforeseen maintenance costs come up, that's when they start digging deep. So if I was looking to have somebody or interview a property management company, I would definitely ask how maintenance is handled. Here in San Diego, it makes a lot more sense to have maintenance staff, I know, because all those little things you're not going to get a vendor to do very cheaply to, fix the leaky faucets and change the screens and change the door locks. Like those kinds of things get expensive. So I would definitely want to know how maintenance is handled, and I would like to also know how emergencies are handled too, because that's when things can get really expensive. You have one maintenance emergency, and vendors hear that and they're like, score, I'm going to charge double time and I'm going to do all those things. So again, the maintenance staff has been really valuable for us because you have people on staff and you're paying them time and a half, but you're not getting that huge upcharge as well. So I would definitely make sure of that. You want to make sure that your management company is like reputable and all those things, that they have a trust account, that they have workman's comp, that they're properly insured. That is hugely important. Again, when it comes back down to the money situation, so vacancies, how they handle vacancies and how they market their vacancies is also a question I always ask. So what happens when things aren't renting? How quickly are you getting in touch with me to strategize? Those kinds of things are really important because it comes back down to the bottom line. So I don't want to see my unit sitting vacant for months. If that happens, I know we have a problem, and usually it's a pricing issue. So that's kind of what I would ask and see about how they handle those things. Of course, reporting is important. The reports should be very easy to understand and easy to look through. Nobody really wants to have to call their property management company. They just want to review their reports, understand them, say, okay, this makes sense, and move on with their life. Hopefully, this is more of a passive investment. So that's really important. I think lastly too is just, this is kind of an obvious, but make sure that you have a good fit personality wise too, because if your philosophy and your kind of personalities jive, you're going to work much easier together when you do have that call about that problem tenant or that big maintenance issue comes up. If your philosophy is similar, you're going to get along a lot better and work as a team.
That's awesome. Well, thank you for that. Well, so we've reached time. I'd like to close, but before I do, I think just building on that last question, I'd like to let everybody know here that I got the permission to offer everybody 1 month free property management service if you sign up with Mynd. Now, that doesn't mean you have to sign up today or tomorrow, but the one thing that I want to let you all know is that we're here to have a conversation with you. As both Krystle and Steven mentioned, It's really important for you to get to know your property manager. We would love to be your property manager. We're in 16 markets all over California, Seattle, Reno, Phoenix. We're probably in the market you're thinking about investing in. So if you want to have a conversation with us and learn a little bit more about us, and if you're serious about making these investments over the next couple of years, I would suggest you start looking for a property manager. We're happy to be that, but we want you to talk to somebody. So the email is on the screen. Feel free to email us if you want to have a chat. It's at bd@mynd.co. Sorry, not .com. Just to be clear, it's .co. And if you want to have a chat, please have a chat with us. We're always here to listen. That being said, I'd like to thank Krystle, and I'd like to thank Steven for spending this time with us. I have taken a bunch of notes, and I'm going to take some time later to digest them. Hopefully you all did too, but thank you for sharing your expertise and your knowledge, and we look forward to having you again at another event with ours soon.
Awesome, thanks so much.
Thank you.